What if I told you that while everyone's fighting over AI stocks, the real money is quietly flowing somewhere else? I'm talking about 5 specific REITs that Wall Street giants are silently loading up on, but nobody's talking about. In fact, institutional investors have been strategically increasing their positions by billions, yet mainstream media remains fixated on tech stocks. Let me tell you a quick story that changed my entire perspective on real estate investing. 2 years ago, I was trapped in the traditional real estate game, just like many of you watching right now. Midnight calls about broken toilets, tenants not paying rent, and property maintenance eating away my profits became my daily reality. I owned 3 rental properties that were supposed to be my path to financial freedom, but instead, they became a second full-time job. Then I discovered something that transformed my entire investment approach. While I was struggling with those 3 rental properties, these 5 specific REITs were quietly generating more income than my entire real estate portfolio, without any of the headaches. Think about this for a moment. A $50,000 rental property down payment might get you $500 in monthly income. But the same amount invested strategically in these specific REITs, you could be looking at significantly higher returns without ever having to unclog a toilet or chase down late rent payments. But here's the thing, and this is crucial, you need to act fast. We're entering a unique period in the market where 3 major factors are converging: shifting interest rate expectations, institutional money flow, and a massive transformation in how real estate is being used in the AI economy. This window of opportunity won't stay open forever. In today's deep dive, I'm going to show you exactly why traditional real estate investing is becoming obsolete for the average investor. Reveal the 5 specific REITs that could potentially double your income in 2025, and share my exact blueprint for maximizing REIT returns in this market. Plus, if you stay until the end, I'll share a bonus strategy that could potentially triple your REIT income. Something I've never revealed before on this channel. Quick favor before I show you how to potentially double your real estate income in 2025. Destroy that like button and join our investing community by subscribing, because what I'm about to share could change the way you think about REIT investing forever. Before we dive into these 5 game-changing REITs, let's understand why 2025 is creating a perfect storm of opportunity in the REIT market. What we're seeing right now is nothing short of a massive shift in how institutional money is flowing into real estate. And it's all tied to 3 critical factors that are converging at once. First, let's talk about interest rates. For the past year, everyone's been focused on the Federal Reserve's aggressive rate hikes. But here's what most people are missing. Historically, when interest rates begin their descent, REITs don't just perform well, they often outperform nearly every other asset class. Why? Because as borrowing costs decrease, these REITs can refinance their debt at lower rates, instantly boosting their bottom line. And with the Fed signaling potential rate cuts in 2025, we're standing at the edge of what could be a golden opportunity. But there's an even bigger story developing beneath the surface. The real estate market is undergoing its biggest transformation since the rise of e-commerce. AI and technology companies aren't just renting office space anymore. They're requiring specialized properties with massive power requirements, advanced cooling systems, and strategic locations. This isn't just changing how properties are used, it's creating entirely new categories of real estate that these REITs are perfectly positioned to capitalize on. Here's where it gets really interesting. Institutional investors, the smart money that typically moves first, are quietly repositioning their portfolios. We're seeing massive inflows into specific REITs that are positioned at the intersection of traditional real estate and future technology needs. While the mainstream media is still focused on AI chip manufacturers, these REITs are quietly building the infrastructure that will power the next decade of technological advancement. Think about this. In the last real estate boom, the winners were those who understood how e-commerce would transform industrial real estate. The investors who got in early with companies like Prologis saw returns that dwarfed the broader market. Now, we're seeing a similar shift, but this time, it's even bigger because it's happening across multiple sectors simultaneously. But here's the critical part, and this is why timing is so important right now. Unlike previous real estate cycles, we're seeing a unique disconnect between REIT valuations and their underlying asset values. Many of these high-quality REITs are trading at significant discounts to their net asset value, creating what I believe is a rare opportunity for investors who understand what's really happening. And speaking of opportunities, let's dive into our first REIT that perfectly exemplifies everything we've just discussed. This is a company that not only understands these market shifts, but is strategically positioned to capitalize on them. I'm talking about VICI Properties, ticker symbol VICI, and what they're doing right now in Las Vegas might be the most interesting real estate play of 2025. Let me dive into our first REIT powerhouse, and trust me, this one's particularly exciting. Let's talk about VICI Properties, and I'll tell you exactly why this isn't just another casino REIT. It's potentially a money-printing machine hiding in plain sight. Think about Las Vegas for a moment. While most people see bright lights and slot machines, VICI saw an opportunity to become the largest landlord on the most famous strip of real estate in the world. We're not talking about owning a few buildings here. VICI owns the crown jewels of Vegas: Caesars Palace, MGM Grand, Park MGM, Mandalay Bay, and get this, they're transforming the Mirage into a state-of-the-art hard rock casino shaped like a guitar. That's the kind of forward thinking we're looking for in 2025. But here's what really sets VICI apart, and this is crucial for your investment decision. During the pandemic, when most real estate companies were struggling to collect rent, VICI maintained a perfect 100% cash collection rate. Think about that. During the worst crisis the hospitality industry has seen in decades, every single tenant paid their rent on time, every time. This isn't just impressive, it's almost unheard of. Now let's talk numbers, because this is where it gets really interesting. VICI is currently trading at what I believe to be a significant discount. With a forward price to FFO ratio of 12.7 times, it's well below their 5-year average of 16.3 times. In simple terms, this Ferrari is currently priced like a Toyota. But here's what Wall Street analysts are seeing that most retail investors are missing. They're projecting a 12-month price target of $35, implying a 20% upside from current levels. And that's just the capital appreciation potential. On top of that, you're getting a juicy 5.97% dividend yield, a dividend that's been increased every single year since their IPO. When you combine the potential 20% price appreciation with that nearly 6% dividend yield, you're looking at a possible total return of around 26% in the next 12 months. That's the kind of return that can make a real difference in your portfolio. Let me be clear about something though. This opportunity exists because most investors are still viewing VICI through the old lens of being just a casino REIT. But when you understand that they're really a premium real estate company with irreplaceable assets on the Las Vegas Strip, working with some of the best operators in the business, the picture changes completely. Now, let's move on to our second REIT, which is playing an entirely different game, but might be even more exciting for 2025. Let's shift gears and talk about our second REIT, which is basically the landlord of the AI revolution. I'm talking about Equinix, ticker EQIX. And if you've been wondering how to invest in AI without buying overpriced tech stocks, pay very close attention to this one. Here's what most people don't realize about artificial intelligence. All those chatbots, image generators, and AI models everyone's talking about? They need a physical home. They need massive amounts of power, cooling, and specialized infrastructure. That's where Equinix comes in, and they're doing it better than anyone else in the market. Let me put this in perspective. While most REITs were struggling last year, Equinix shares shot up 19%. Think about that. In a year when real estate was supposedly dead, Equinix was thriving. Why? Because they're not just any real estate company. They're the largest data center REIT in the world, and they're absolutely crucial to the AI revolution. Now, here's where it gets really interesting. Everyone knows companies like NVIDIA are making the chips for AI. But where do you think all these AI companies are running their operations? Equinix's data centers. They're essentially becoming the picks and shovels of the AI gold rush, but with a real estate twist. But let's talk numbers, because this is where some investors might get nervous. Equinix trades at a forward price to FFO ratio of 34.7 times, which is above their 5-year average of 30 times. Yes, it's not cheap, but here's why that premium is justified. While traditional REITs are offering higher yields, Equinix is playing a different game. They're giving you a 1.8% dividend yield, but with an impressive 11.61% 5-year dividend growth rate. That means they're reinvesting in growth while still rewarding shareholders. Think about it this way. Would you rather have a high yield that stays flat or a growing dividend that's doubled your income in just 5 years? That's the power of Equinix's strategy, and it's why analysts have a price target of $1,027, suggesting another 10% upside from here. But here's the most exciting part that most investors are missing. We're still in the early stages of the AI revolution. As more companies rush to build and deploy AI models, they're going to need more data center space. A lot more. And guess who's positioned to benefit from this surge in demand? Equinix, with their strategic locations and existing relationships with major tech companies. Now, let's move on to our third REIT, which is playing an entirely different angle of the future economy. Now, let me introduce you to what I believe might be the most misunderstood opportunity in the REIT market right now. Prologis, ticker PLD. And let me tell you why this recent 20% drop in share price might be the opportunity of the decade. First, let's address the elephant in the room. Yes, Prologis is down 20% over the past year. But here's what most investors are missing. This isn't just any REIT. This is the largest REIT in the world, with a massive $98 billion market cap. And right now, it's trading at a discount that we haven't seen in years. Think about this. Every time you click Buy Now on Amazon or order something online, there's a good chance that package is going to pass through a Prologis facility. They're not just playing in the e-commerce space, they're dominating it. But here's where it gets really interesting. They're now expanding into data centers. It's like they're combining the two biggest trends in real estate, e-commerce and digital infrastructure. Now, let's talk numbers, because this is where the opportunity becomes crystal clear. Prologis is currently trading at 18 times forward FFO. To put that in perspective, their 5-year average is 25.6 times. In simple terms, you're buying a Ferrari at Honda prices. And not just any Ferrari, the biggest, most successful Ferrari in the race. But here's what really excites me about Prologis. While you're waiting for that 20% upside that analysts are projecting, their target price is $129. You're getting paid a solid 3.68% dividend yield. And this isn't just any dividend. They've been growing it at an impressive 12.62% rate over the past 5 years. Do the math. That's like getting both growth and income in one package. Here's the part most people miss about Prologis. Everyone's worried about interest rates and the economy, but they're forgetting one crucial fact. E-commerce isn't going away. In fact, it's still growing. And as more retail moves online, someone needs to own the warehouses where all these goods are stored and distributed. Prologis isn't just participating in this trend. They're the landlord making it all possible. And let me tell you something that most analysts aren't talking about. When interest rates eventually come down, and they will, REITs like Prologis typically see massive appreciation. Why? Because their borrowing costs go down while their rental income stays stable or grows. It's like getting a pay raise without doing any extra work. Now let's move on to our fourth REIT, which might be the most controversial pick on our list, but could also offer the biggest potential returns. Now, let me tell you about what might be the most controversial pick on our list, but potentially the most rewarding one. Rexford Industrial, ticker REXR. And if you think the California real estate market is dead, you might want to think again. Look, I get it. Rexford is down 32% over the past year. Southern California real estate has been making headlines for all the wrong reasons. Rising vacancies, high interest rates, companies leaving the state. It sounds scary, right? But here's where the opportunity lies, and this is what Wall Street is missing. First, let's talk about what makes Rexford different. While other REITs try to be everywhere, Rexford has laser-focused on one market, Southern California. Some might call this risky, but here's the genius part. They're operating in the world's 5th largest economy, in one of the most supply-constrained industrial markets on the planet. It's like having a monopoly on beachfront property. They're not making any more of it. Now here's where it gets really interesting. Rexford is currently trading at 15.2 times forward FFO. Want to know their 5-year average? 33 times. Let that sink in for a moment. This REIT is trading at less than half its historical valuation. This isn't just a discount, it's a fire sale. But here's what's really exciting. Analysts are projecting a 12-month price target of $58. That's a potential 50% upside. Not 15%, not 20%, but 50%. And while you're waiting for that appreciation, you're getting paid a 4.34% dividend yield that's been growing at an astounding 17.68% rate over the past 5 years. That's one of the fastest dividend growth rates in the entire REIT sector. Think about this. All those headlines about companies leaving California, they conveniently forget to mention that Southern California still has one of the lowest industrial vacancy rates in the country. Why? Because it's home to the 2 largest ports in the United States. Every company that wants to sell products in the western United States needs to go through these ports, and guess who owns the warehouses they need? Rexford. Here's my prediction. When interest rates start coming down, and they will, Rexford could be one of the fastest moving REITs in the market. Why? Because all the headwinds they're facing. High interest rates, market sentiment about California. These are temporary. But their strategic position in one of the most important industrial markets in the world? That's permanent. Now let's move on to our final REIT, which might be the most recession-proof pick on our list. Let me introduce you to our final REIT, and quite possibly the most recession-proof investment on our list, Extra Space Storage, ticker EXR. And let me tell you why this might be the perfect defensive play for your portfolio in 2025. Here's a fascinating statistic that tells you everything you need to know about this business. In 2000, only 5% of American households used self-storage. Today, that number has exploded to over 11%. We're talking about an industry that's literally doubled its customer base, and here's the best part. It's still growing. Now, Extra Space Storage isn't just any player in this space. After their brilliant merger with Life Storage, they've become the largest self-storage REIT by square footage in America. We're talking about 2.7 million storage units across 42 states. That's not just scale, that's dominance. But here's what makes this REIT particularly interesting right now. While other REITs have been getting hammered, Extra Space is only down 6% over the past year. Think about that. In a year when real estate was supposedly toxic, this REIT has basically held its ground. Why? Because self-storage is arguably the most recession-resistant real estate sector there is. Let me explain why. In good times, people buy more stuff and need more storage. In bad times, people downsize and, you guessed it, need more storage. It's a win-win business model that works in virtually any economic environment. Now let's talk numbers, because this is where it gets really exciting. You're getting a solid 4.38% dividend yield, but here's the kicker. They've been growing that dividend at a 12.73% rate over the past 5 years. That means if you hold this for the long term, your yield on cost could potentially double or triple. But here's what most investors are missing. Extra Space is currently trading at 18.2 times forward FFO, below their 5-year average of 20.9 times. After a merger that made them the biggest player in the industry, they're actually trading at a discount. This doesn't make sense, and the market will eventually figure this out. Analysts are projecting a price target of $173, implying a 15% upside. Combine that with the 4.38% dividend yield, and you're looking at potential total returns of nearly 20%. For a defensive, recession-resistant investment, that's impressive. Here's my final thought on Extra Space Storage. In a world of economic uncertainty, this is the kind of REIT that helps you sleep at night. It's not the flashiest investment on our list, but sometimes boring is beautiful, especially when it comes to generating consistent income. Before you rush off to take action, let me give you your REIT domination strategy for 2025. Your first power move should be what I call the foundation play. Start with either VC or Extra Space Storage. These are your dividend powerhouses. And remember, we're buying Ferraris at Toyota prices right now. Next comes the Value Hunter strategy. Keep some dry powder ready for Prologis and Rexford. The market's giving us a gift with these discounts, and when others panic, that's when we pounce. Finally, implement the Growth Accelerator by layering in Equinix strategically. Yes, it's premium priced, but remember, The best opportunities in life rarely come cheap. Here's a pro tip that took me years to learn. Don't try to time these perfectly. Start small, build positions gradually, and let time be your best friend. The real wealth in REITs comes from consistent investing and dividend reinvestment, not from perfect timing. Now, if you found value in today's deep dive into these 5 powerhouse REITs, do me a quick favor. First, smash that like button. It really helps the channel reach more investors like you. Hit subscribe because we're just getting started. I've got more hidden gems coming your way that you won't want to miss. Drop a comment telling me which of these 5 REITs you're adding to your watch list first. I personally respond to early comments and love hearing your thoughts. This content is for educational purposes only. Always do your own research and consult with a financial advisor before making any investment decisions.